Last week's doji candle saw follow through to the downside. Are we at the top yet? Let's go. When we look at a heat map of the weekly, we notice that this week did have pockets of areas where traders were able to find success. Financials, consumer defensives, utilities, basic materials, and energy. Flipping over to the weekly, where we see the ratio of tech to the S&P 500, we can see that we've been holding this trend line for a while now. And it would have been nice to see another bounce here, but instead we saw ourselves break this trend line for the first time in a while. So on this candle, we're actually getting some evidence that money is starting to rotate into other sectors. This is why lately I've been working hard to add new sectors to the stocks that I trade and alert on, because at some point it's about wanting to go where the soccer ball is going and not where it's been. Make sure to subscribe, as I sometimes put out YouTube shorts on these signals that can help you get into trades. And if we look at the percentage of stocks trading above their 50-day simple moving average, is this 2-week candle combination signaling it's time for a reversal. Now, this doesn't mean that some sectors can't trade well. They will. It just means that it's time to be more selective. Let's get a little more confirmation by looking at SPY Weekly. On SPY Weekly, we see that essentially we went nowhere this week. Also, this is the first time we've had 2 down weeks in a row since the last correction that finished in October. Is it time to buy the dip? To answer this, let's go ahead and zoom a little bit more of price into view, and let's turn on the Bollinger Bands. When we look at the weekly Bollinger Bands, we see that the last time after a rise that they went ahead and flattened out was right before we went into the last correction. Now, I'm not saying we're going to go into another correction, as we're more likely to go into some pullback of where we maybe retrace 5 or 10%. And let's face it, a pullback is getting likely as we had selling volume that was higher than average. As long as we hold this 5 exponential moving average and we don't lose this 505 area, the trend is your friend. Now the Qs, they're looking a little weaker, as we saw a little bit more follow through to the downside, and they actually closed below their 5 exponential moving average. And for the Qs, it's been a couple weeks now that we've seen selling volume higher than average. And this MACD, is it getting ready to cross below the signal? We can see when this happened in the past, this is usually not a good sign on the weekly. Looking at the Russell, we can see that the IWM had a pretty strong reversal off of its doji from last week and retested its breakout area and wicked and closed. But it wasn't able to hold its 5 exponential moving average. And it's been my experience that the market doesn't make mistakes. Now, coming down and retesting this area and bouncing and then moving higher is normal market behavior on retesting a breakout. What I don't want to see is have this thing come back into range, because I don't want to follow this thing down to the bottom of range like it's been doing for the last 2 years. Now, flipping over to US 10Y yields. Last week when we looked at this, I mentioned I was really hoping that we went ahead and lost this 50 EMA, with maybe good CPI and PPI reports. But instead we bounced. And when we bounced, we broke up through all the moving averages. It seems like bond traders were smart to follow the hot CPI, PPI signals instead of thinking about how AI trades may be worth a lot of money someday. Now, today we almost got a VIX Crush Friday, as today the VIX was up only a little bit. But from a weekly perspective, you can't deny that we've been in an uptrend. And even today, we were flirting with the highs of the weekly candle until we pretty much closed where we opened it. This week, there really isn't a whole bunch on the economic calendar, but as I mentioned earlier, anytime Fed Chief Jerome Powell and crew get together, it's going to cause some market volatility. If you want to see how everything I discussed tonight fits in with the next higher degree trend, which is the monthly, then watch this video right here. As that's all I have until the next video, and we'll see you then.